to our live stream. Hope you all had a good Thanksgiving weekend for anyone who's based in the United States. So, the reason why we do these live streams is we know that crypto tax reporting can be confusing, it can be stressful, and we just wanted to simplify the process for all of you out there who might be watching. So, my name's Dheeraj. I'll be your host here today, and with me, I have two special guests. First is Jordan Bass. He's a CPA, LLM, JD. He also runs his own crypto tax and crypto legal firms, and he somehow also has time to do these live streams. So, how's it going, Jordan?
Doing well, man. Glad to be here today and discuss some crypto tax issues week after Thanksgiving. Everyone can start planning for year-end taxes. We had a little bit of a dip there, so hopefully people were harvesting some of those losses. But yeah, happy to be here today.
Absolutely. Our next guest is our CEO here at CryptoTrader.tax, David Kemmerer. He co-founded the company back in 2017. So, as you can imagine, he's seen a lot of developments from the IRS, and he's had a lot of experience in this space. What's up, David?
Not much. I also bought the dip a couple days ago and am doing good off that buy now. Excited to drop some crypto and NFT tax alpha on the community.
Great to hear. So I will get started asking some questions, but first, a short little disclaimer. This session is for general informational purposes only. It should not be construed as financial, legal, or tax advice. Well, now that we got that out of the way, couple pieces of news I want to cover. The first is something I'm sure many of you have heard about already. President Biden signed the infrastructure bill a couple weeks ago, and there are major implications for the crypto ecosystem. So, Jordan, can you tell us about how crypto tax reporting might be changing in the near future?
Yeah, definitely. I think the main things that taxpayers need to be aware of at a high level is twofold, right? One, what is the definition of a broker and how that's impacted reporting requirements for not just centralized exchanges, but in theory, what could be a lot of other actors in this space that maybe, in our opinion, should not be forced to abide by these rules. But what that's going to do for the individual taxpayer, because I think that's where we should focus on, is it's going to allow the IRS to have information reported to them from these exchanges, from, in theory, even more actors that would solidify the fact that these particular individuals are holding, are buying, are selling, are transacting with digital assets. It's not something that changes the actual taxation of digital assets. It's the same sort of treatment, the same sort of software solutions like CryptoTrader.tax would need to be used to aggregate all the information. But what it does is kind of facilitate a way for the IRS to obtain this information automatically by way of like a 1099-B. And the IRS had previously been issued some forms from these centralized exchanges that caused confusion, that caused issues, and that's probably what's going to be the same thing, albeit a different form. There will probably be those same issues where people are now receiving forms from these centralized exchanges or from others with the information not being completely accurate, right? Because those exchanges don't interact with each other. If you're on Binance US, Coinbase, Kraken, if you're using Uniswap or SushiSwap, all these places are not interacting with each other. So you're still going to have to aggregate that information yourself. The difference is now the onus is on these people that are facilitating the transactions, or what the bill says, effectuating crypto transactions, to report this information. So it's not like it's completely on the taxpayer to disclose all of the information. The IRS will start obtaining some information from these individuals or about these individuals based on the fact that they've KYC'd, they've provided their social security number, their driver's license or passport with some sort of fiat on-ramp. And that's really at a high level, that's what's really changing on the reporting requirements from the centralized actors or people that are facilitating transactions that will impact investors. The second level that is actually maybe a little more scary, I would say, is the ability for the IRS to add the cash reporting requirement, right? Like we have currently with cash transactions, but translating that into what it looks like in the digital asset space, right? So any transaction above $10,000 in cash right now currently has to be reported. There's a form that has to be filled out. It's called the 8300. And that goes about, making sure the IRS knows that a particular transaction or transactions occurred over that threshold. That is now going to be included when we're dealing with digital assets, which could be very, very difficult to manage, specifically for businesses that are transacting in crypto. As we know, 2.5 ETH right now would get you above that threshold. So those are kind of at a high level the main things that have changed. The problem with the second one that we're talking about, the 6050I, is that it not only comes with financial penalties, but there also are criminal penalties. It's a felony to not report this stuff accurately, and we may not have the infrastructure to actually get all of this information from people with transactions occurring $10,000 or more. It might not be feasible. So the good thing is we may have bills to amend this. We may have periods of time where people can argue and say their position of why there should be a little bit of a carve out in each of these bills for these particular issues. And I think in due time that might happen, given the fact this doesn't come into play until 2023 for some. But at a high level, that's what we're looking at. That's what passed about a couple weeks ago.
Gotcha. So, David, you've written a little bit about this tax reporting problem that the bill would create. Can you tell us a little bit more about that? Jordan touched on it a little bit, but I'm wondering specifically how would this impact our customers?
Yeah. So as Jordan mentioned, the nice thing, right, there's a lot of scary language, put out by all this, but at the end of the day, this really impacts the businesses operating in the space, right? As Jordan said, most people who are watching this are probably individual users and cryptocurrency investors. At the end of the day, you're not actually drastically affected by this, right? Again, it's the IRS and governments around the world who are trying to just increase the enforcement mechanisms for them to understand, who should be paying taxes on crypto activity, right? And these laws are designed to increase those enforcement mechanisms. Again, at the end of the day, the laws around how cryptocurrency taxes work and should be filed aren't changing. And so, if you're on this stream, I'd imagine you've probably been reporting your cryptocurrency taxes now or in the past. So you're fine, right? You don't have to worry, right? It's more if for whatever reason you're on the stream and you're running a business that's facilitating crypto transactions, man, you have a lot higher compliance costs to hire lawyers and figure out how to navigate these waters. And so that's a bummer because the barrier of entry of innovating in the space gets risen, right? With all of this legislation that gets passed, it becomes more expensive to operate a business in this space. Now, I'm not saying that we should have laissez-faire, right? Just no rules in the space. We need logical, sensible, and clear regulation. But I don't know if we're getting that from this infrastructure bill that was passed, right? It's pretty clear that the folks who are writing and passing this legislation have no idea what's going on in the space. And so that's a bummer, but all the businesses in the community we've seen can band together and hopefully get things changed so that it is sensible and the regulation makes sense. But at the end of the day, you as a cryptocurrency user, a cryptocurrency investor, are not going to be drastically affected by these laws.
Well said. So just to summarize, it's not like your crypto tax rates will be going up necessarily, but it is something that might hurt the ecosystem as a whole, you might say. So another piece of news I do want to cover, earlier in the month, we did have the ENS airdrop. So for those of you who are not familiar, basically the way it worked is that anyone who used the Ethereum naming service in the past had the ability to claim ENS tokens. And those actually turned out to be quite the treasure trove. I think David can attest. I think he claimed those himself. But Jordan, can you tell us a little bit about how those types of airdrops are treated from a tax perspective?
Yeah, for sure. So, this was actually kind of a little bit different. Not necessarily like an airdrop per se, but when you get airdropped tokens into your wallet, effectively what happens is it's income upon receipt. You have the ability to exercise dominion and control over the asset. It may not be something that you wanted, right? It could be an airdrop that you didn't know you were going to be participating in, and I think we're actually gonna talk about that a little bit later. But that's technically how the tax treatment would be, right? It's income upon receipt. With the ENS airdrop, it was slightly different, and I hate to call it an airdrop because you actually had to go and claim those tokens, right? You had to pay a little bit of gas, which maybe was a lot depending on what time of the day it was and how congested the network was, and you did that in order to claim your reward. So the argument in theory could be made that it's, an acquisition of something that you had the ability to acquire, right? It wasn't like an airdrop per se. I think the safest route to go is to treat it as income upon receipt. And I know the price was relatively high at the time that the drop was facilitated, at the time the market started operating, when there was a liquidity pool for you to freely sell those tokens. So you could actually go and check what that price was, or using a tool like cryptotrader.tax, whenever that hit your wallet, you can pull in the price via some sort of API and you can determine what the income was. Again, though, there is an argument possibly to be made that you had to actually do something to acquire those tokens, and that could maybe set your basis. That's something you would want to talk about with your tax preparer, your legal counsel, your CPA to figure out what position makes the most sense for you. But again, the most conservative approach would be to treat it like other airdrops where it's income upon receipt. If you subsequently sell it, then your spread between what you got it for, what the income amount was, and what you sold it for, whether it's up or down, would be gain or loss, right? That's slippage. Otherwise, and that's not really much different from airdrops we've seen in the past. It's a little different. The reason why I say it's a little different in terms of how you maybe could treat this from a tax perspective is because when the IRS actually issued guidance on airdrops and hard forks, they were talking, you could argue they were talking about that specifically, and this is a slightly different transaction structure. But again, conservatively, just like every other airdrop, income upon receipt, that sets up your cost basis. Or maybe the argument can be made that you've acquired these tokens for whatever you spent to acquire them. But if you subsequently sold them because the price went up in value significantly, it would be ordinary income anyway on a short-term basis. So it kind of could be the same, just depending on what tax year the secondary sale occurs. But at a high level, those are really the only options, and I would imagine most people are treating it as income upon receipt.
Got it. So Jordan mentioned how you could report these airdrops through a platform like cryptotrader.tax. David, can you tell us a little bit more about how this works?
Yeah, so I was lucky enough, I bought dchem.eth a number of months ago, and so I claimed my ENS tokens when it was announced. It made a few $1,000, which was great. And so you can essentially just import that airdrop into a platform like ours, and we'll give you a report, essentially an income report that shows how much income in your fiat currency, if you're here in the United States, it's going to be USD, and that just adds on to your total income for the year. So let's say I made $80,000 from my job during the year. I made a few $1,000s on the ENS airdrop. Well, now I have $83,000 of taxable income for the year. I owe taxes on that. So it's pretty straightforward. Where people can get into a little bit of trouble with something like this is you realize the income whether you sell that ENS or not. And so we saw this, Jordan, in 2017 when a lot of people had incurred a lot of income and then the market tanked. And all of a sudden you have a tax bill that maybe your assets can't even afford, right? Because of the amount they've dropped. And so it's wise just to understand how the tax implications work so that, if you want to just be conservative and sell some of that, for example, ENS, to afford the taxes on the $3,000, $4,000 or $5,000 of income that was incurred, then you can do that. But that's how it works, again, at kind of the high, simple level.
Got it. That's good to know. So I do know that we've had some questions from the audience. I have some pulled up in front of me from Twitter as well. We'll try to get through as many of these as we can. So here's one. So if you did your taxes last year, you saw the question the IRS asks on Form 1040, which asks taxpayers if they've traded digital assets in the last year. Does answering yes on this question increase your likelihood of facing an audit?
It's a great question because a lot of people want to know that, right? Because sometimes they don't want to check the box yes if they've maybe merely only acquired assets. That's technically guidance that was released by the IRS that they said, if you've only just acquired crypto, maybe you don't need to check the box. If you've only just transferred crypto to yourself, maybe you don't need to check the box. I always advocate for checking the box because it's merely informational, much like foreign financial reporting requirements that doesn't incur any additional tax liability. It's just so that the IRS can obtain some information on you, which of course maybe you don't want to provide. But the problem with not doing that is not the potential for audit, it's the potential for fines and penalties for failing to disclose something on a return that could lead to specifically those sorts of penalties. And when you're signing off on your tax return, you're signing it under penalty of perjury, right? So technically now you're lying if you know you had crypto and you didn't check the box yes. The fact of the matter is the IRS rarely audits individuals. They do. It's not like there's no audits throughout the year, but it's a very, very small percentage. By checking the box no, with the IRS maybe having information and they already know from like a John Doe summons that they received from Coinbase or the new one that's going to, going on with Kraken, when they know that you have or have purchased crypto, maybe that would automatically trigger some sort of inquiry. I don't know about a full-on audit, but at least some sort of notification that could tend to lead to something more intrusive. But there's no issue in checking the box yes. And moving forward, it would be very unwise to not check the box yes when you have bought or sold crypto because of these new reporting requirements. That stuff is going to automatically be transferred over to the IRS. It's not something like when you meet a certain threshold in terms of US dollar amounts, they're getting this information. It's just going to be there. So, in my opinion, you always want to limit your exposure for anything. And so, by checking the box, yes, you're just merely providing information. You're then probably going to be using a tool that's going to help you, calculate your gain or loss or income, right? So that's easy, effectively, to report that. And then lastly, you don't have to worry about something down the line, 2, 3, 4 years where there's an inquiry because you didn't check the box yes, not because you maybe missed something that's immaterial. So there's no reason to not check the box yes. I haven't seen in my practice it leading to audits, but what I have seen is people not necessarily filing anything, zero crypto reporting, and then receiving letters from the IRS for 2017, for 2018, even for 2019, based on information that they had that would lead them to believe that you did transact or that individual did transact in digital assets and just failed to disclose or report any. So that's just my personal opinion. I think that's the opinion of almost every tax professional. And I would pretty much say that it's very unlikely that would lead to an audit just by checking that box, because those don't tend to happen that much anyway. Usually it's when, they have some information on their end and the taxpayers reporting the compliance, the returns don't match up. So that could lead to an audit, right? If you say no, or if you don't check the box yes, but they know you have or bought or sold or transferred digital assets, or they call virtual currency on the tax form, which will probably change because it doesn't line up with the terminology in the bill.
Totally. I'd echo the same thing. I get asked this question all the time, right? How can I not pay taxes on my crypto? My answer is all the same. It's a risk you're taking, right? I personally am not going to advise you of like, yes, no, but you just have to understand the risks that you're taking by not checking the box or not filing your crypto taxes. And that's just kind of a risk that you have to decide how much you're comfortable taking. Again, if you seek the advice of professionals, you might not always like the answer that we give, but it's just the reality.
That's well said. So here's a question that we just got in the chat. So can someone explain how staking rewards are taxed?
Yeah, sure. Staking rewards, very, very popular question over the last 18 months. There's a bunch of different ways that you could effectively be staking, right? You could maybe be running your own node. You could be paying for someone to, like, some sort of service to do that for you. You can be single side staking on, some sort of DeFi protocol like Trader Joe or Sushi Swap with those X Joe or X Sushi tokens. Or you can be staking, let's say, in like some sort of rebase token that's very popular lately. Ultimately, those are all income generating events. The difference and discrepancy in people's opinion lies in how to classify the income. The outlier being the rebase tokens, because those transactions are slightly different. But basically, once that reward hits your wallet, once you have the ability to control those funds, right? That's when the income is generated. And that income could technically be ordinary income. Maybe people argue that income is some sort of passive activity, like a rental income per se, because you're renting out your computing power. Let's say that's the argument. There is a case right now going on in Tennessee where taxpayers paid their tax liability, right? But they're making the argument that their staking rewards should not be deemed to be income until they actually dispose of them, until they actually sell. So that's something to keep an eye out for, but that's probably not going to be finished. The litigation is not going to go through until, many years, let's say. But staking rewards are technically, based on IRS guidance and taking into consideration things that we've done in the past and relying on that, it's income upon receipt. There's many, like I said, many different structures of how those transactions occur, but ultimately at a high level, again, it's just treated as ordinary or maybe possibly some sort of passive activity, but it is income. And tools like cryptotrader.tax can help you account for that stuff, especially if it's on chain, right? So that is, what you need to be aware of. It's something like David mentioned earlier. When you get an airdrop, you have this income, and it could increase your taxable income, your adjusted gross income for the year, which can pull your tax liability up. Same thing with staking rewards. If you're constantly earning these rewards, but you're not taking any out or selling for USD to reserve for a potential tax liability, at the end of the year, when you start to report those staking rewards, which are taken at the spot price US dollar value at the time it's received, but let's say those tokens, you've never taken profit, and those tokens have drawn down 50, 60, 70%, now you might be paying out the entire reward for the year as a tax liability, possibly, depending on what your income level is. So there's a lot more to it with staking, but at a high level, again, that is when the income is generated.
Right. So
Yep, I don't have anything to add. That was very good.
yeah, very well said. So here's a question that just came in that I think is an important one. It's one that we've been getting a lot lately. So are staking rewards income when you claim them or when you are able to claim them? I know that this can vary for certain protocols.
Good question. Good question. So that gets more along the lines of not the traditional sort of staking income, but maybe that single side staking where you have to claim the rewards. They're always populating, they're always accruing in your wallet, basically as a aggregation of fees on some sort of platform, or like the example that I mentioned previously, the rebase tokens. You have to technically claim, you stake your assets, and then you can unstake and claim those rewards, but if you don't, they just keep building on top of each other, right? And you're using that as some sort of yield aggregation so that you don't have to necessarily, you can earn more yield, right? You have more staked assets in that protocol, so you, in theory, earn more of this staked asset every rebase. That's how those rebase tokens occur. The argument can be made that it's not income until you claim those rewards. Maybe you just have something similar to like a liquidity pool providing token, like an LP token that's like effectively a receipt that says you have the right to receive these assets and then you can claim them. But the safer, more conservative, probably the correct tax position, because again, we don't have guidance on these particular instruments, but I'm sure that will come. The safer way to do it is, well, if you have the ability to exercise dominion and control over when you can claim the rewards, then it's most likely income upon receipt, regardless of whether you claim them or not. That's maybe leaves you open the option or the possibility to take a more aggressive position and say, well, hey, you know what? This is locked up. Actually, this isn't something that I can control, depending on how the transactions are structured. But ultimately, at the end of the day, staking rewards are income upon receipt. So you would want to at the very least recognize the income when it's received. When you do have something like a rebase token that those transactions maybe don't show up on chain, it's actually harder to account for those transactions. But that doesn't necessarily mean just because it's harder to account for them, we're just going to disregard them altogether. The reason why it could become an issue is because if you've generated all of these staking rewards in, let's say, 2021 with a rebase token, or in some sort of DeFi protocol where you're just aggregating all this income, but you don't claim it till the next tax year, well, now the IRS might make the argument that you've shifted the income from one year to another. And that's kind of the argument, right? Depending on if you have a lot of income in 2021 and not so much in 2022, well, of course, you might shift the income to the lower income year and maybe minimize that tax rate, or the amount of money that you pay out in regards to the amount of staking rewards you've received. So it really is a kind of a gray area on those specific types of transactions. There are things to circumvent that with the rebase tokens. You can kind of wrap those tokens and just play the index, so you get more tokens per whatever the wrapped token amount is all the time, because that index is increasing. So the amount that you can retrieve for those wrapped tokens technically go up, and that's all unrealized gain or loss depending on the price of the asset, for sure. That's 100% how that would be. But when you actually wrap the token, if you've waited 6 months to do that, now you might incur a large taxable event at that point. So it really just depends. But yeah, those are the types of questions that I would definitely advise somebody to reach out to a tax professional, a lawyer, or CPA, have the conversation, see what makes the most sense for your particular tax situation, and then take the position from there. There's no real right or wrong answer right now, but you can look at the code sections, you can look at revenue rulings, you can't really look at case law for this issue, to make a determination of what's the risk reward for either position.
Very well said. So I know we don't have a ton of time left, but I do want to address this question that we got from Twitter. It is a pretty common one that we hear. How do you report spam airdrops to your crypto wallet? So I'm assuming these are cryptocurrencies that get airdropped to you, but you didn't even really want them, and they're probably close to worthless.
Yeah, I mean, that's a good question. Most of the time when that happens, at least in my experience, those aren't worth anything anyway. They're kind of like advertisements, or you get dropped like a billion of XYZ token, but it's worth like 0.00000001 cents, and it's not really worth anything. It's kind of immaterial. You technically want to report all these transactions, right? But if they don't have a market value, if it's just like either spam or advertisement, or maybe something trying to get you to send those tokens somewhere else to exploit your wallet, there's not really an income generation event, because there's no US dollar value. There's no market for those assets. If there is a market for those, I mean, we've seen with, some of the centralized exchanges, they'll kind of like gift you a little bit of tokens, like $2, $5, $7 worth of tokens. And even in your unhosted wallets, that could happen as well. Yeah, technically that's income. It's super immaterial, so it shouldn't have an impact either way. But there's no harm in just adding the $4 or $5 of income on your tax return if you wanted to. But I mean, most of the time those are disregarded, and I always advocate most of the time for most clients, unless they have their dchem.eth wallet and they don't want to get rid of it, to just maybe move the funds that they want into like a separate wallet and just start like cleaning out their wallets, especially at the end of the year. That's a good thing to do. But yeah, I mean, spam airdrops are spam airdrops, so in theory there's really no value to those tokens.
Got it. Got it. So that is all the time that we have. Thank you guys all for your questions. And now, if you want to hear Jordan break down crypto taxes every month, I recommend to hit the subscribe button down below. We do these at least once a month. And if you're looking for an easy way to report your crypto taxes, try CryptoTrader.tax. We integrate with platforms like Coinbase, Kraken, and Gemini automatically, so you can just pull in those transactions and simplify the process once tax time comes around. You can find the link down below in the description as well. David, anything else you want to add on there?
No, I appreciate everyone jumping on. Always happy to do these. And again, spread around the tax alpha. But I'll look forward to the next time I get to see you guys.
Yeah, and thanks for your insight, Jordan. Here's a question or a comment from the crowd. This was awesome. Thanks, Jordan. So people love your insights.
Yeah,
Love it.
Jordan's a smart dude. He's got all the insight. So thank you, Jordan. I will see
Thanks,
you guys
guys.
all soon.
Take
Bye,
care.
guys.
All right,
Have a
take
great
care, everyone.
Cyber Monday.
See y'all. Yep.